Liquidity is the fuel of the market, and in this video, we will dive deep into how it goes together with market structure. And at the end of the video, provide a simple trading plan that you can use today. First, let's get into how the market actually moves. So right now, when price is in an uptrend and is going higher, we say that price is making higher highs and lower highs, and then other higher highs. Price mainly moves like this when there are multiple buyers in the market or there's a certain theme in the market that price is trying to reach for. The same thing, but the opposite is true when we are inside of a downtrend. So when we are selling off, price is creating lower highs and lower lows. So each time price moves down, it creates a lower low, and then it moves back up, creates a lower high, moves back down again, creates another lower low. This is how the market moves when there are multiple sellers who are selling off more than the buyers. When we put all of this together, this is how it looks like. This is a complete market structure diagram. So first we have our higher highs, price is going higher. We have our higher highs, then we have our lower highs, and then we have another higher high, and then the market switches, then we create our lower highs and then our lower lows. Now, at a certain point, price creates a change of character. So when price is creating those higher highs and lower highs, price at a certain point switches and does what? Creates what we like to call a change. All a change of character is, it means that the point at which the other party is going to get inside the market, whether that be the buyers or the sellers. So you can see exactly at this box I drawn here, once price breaks below that area, we are now selling off. Now, I'm going to show you guys all of this on the charts now with actual candlestick and not just line. We have our full market structure here. Don't mind the eyes right now, that's for later. When we talk about liquidity, as you can see, price was moving downwards. We created a lower low, higher low, lower low, higher low, lower low. And then what did we do? We came to this point right here. We created a change of character, and then price started to create higher highs and lower highs. As soon as we created that change of character, the market switched and we started going higher, creating those higher highs and lower highs. It is very textbook, and you can see it especially very well on the higher time frames when you guys are on the charts. This type of market structure just doesn't exist on one time frame, but multiple time frames as well, because price is the same on multiple time frames. So if we go down to the 1 hour, you'll see the same thing. Price creates what? A lower low, a lower low, a lower low, change of character, higher high, lower high, higher high, lower high, higher high. So the same thing that was happening on the 4 hour is happening the same way on the 1 hour. You can mark out these areas the same way when you want to know what direction price would most likely go into. Now that we have gone over market structure, we can now look at liquidity. So when price is creating structural highs, structural lows, the main objective of price is to deliver liquidity and also fill in imbalances, because liquidity is the fuel of the market. In our graph right here, we see that it's the same higher high, higher lows being created, but where is liquidity at? So when we're inside of this uptrend, where do you think that buyers are placing their stops at? They're placing their stops right under these structural lows, right under these structural lows. So when then price turns and shifts around, where do you think that price will target? It's going to target these same people who put their stops right under the lows. Because for the market to keep on moving, it needs an opposite party to either buy or to sell to. If you don't have an opposite party to buy or sell to, the market will not move. The market will look at these orders, that these stops that are right under these areas, and use it as fuel to go in the opposite direction. Now let's go over this same example, but on our candlestick chart. So if we look carefully at the chart, let's see where our sell orders would have been. So let's say we're selling right inside of this area. We would most likely put our stops right above these highs. The same thing in this area, we would put our stops right above these highs. So once the market turns around, it's gonna target these highs right here, these structural highs right here, for it to keep on moving further and higher. And as we said, the market is fractal. So the same thing that happens on the higher time frames happens on every other time frame. So the same way it's going to target these structural highs on the 1 hour, it's going to target these structural highs right here as well. So when the market switches, its main objective is targeting this sell side and this sell side, and then all the sell side up here as well. Now, you will see price sometimes take out key levels when it's either targeting sell side or buy side. You might see, and you probably experienced something like this, where price was moving in your favor. You thought that price would keep going higher. You place your stop in a certain area, and then price creates a grab of liquidity right here, and then keeps on moving higher. So you will see price test these key areas on either trying to move higher towards more liquidity or trying to fill in another imbalance inside of the market. So let me show you guys exactly what I mean by this. So this was a day on NQ. We can see that right in this area, price was creating what? We were going higher, creating higher highs and higher lows. Then we switched off. We started selling off. We took out all of these lows, and then we started selling off for that pullback. But right in this area, what do we see? We see another break, creating a change in character that breaks above these highs. So you would think right here, this was the change in character move, and this was it, so that we can start moving higher now. But what do we see? We see that price induces all of these buyers inside and then moves lower and takes out all of this liquidity. So if you would have gotten in early right here, thinking that this was the move, you would have gotten taken out. Price then moves to another area right here, respects this area, and starts moving higher. So sometimes price will do that, induce people to get in early, and then take those same people out to move in the direction that it wants to go, to take out all of this other liquidity. So if you would have thought, like I said before, if you would have thought that price took out this level and was going to target all this liquidity, you would have been right, but you were wrong on the timing of the market. This is just one of many examples that happen day to day inside of the market. The market moves from liquidity to liquidity, but it's how it does it every day that is where the real problem lies, because it's not going to do it the same way. Every day is different. Every day has a different objective that price wants to fulfill. Now, let's put this all together. So this should be your trading plan. So everything that I spoke about inside of this video should be the first part of your trading plan every day. It should not be your entire trading plan, because we still need a strategy to get inside the markets. Just knowing where liquidity is at is not enough. We need time. We need other things before we get inside the market. But that is for a different video. So every day you wake up, you should first identify what stage of market structure that we are in. Are we in an uptrend targeting sell side, or are we in a downtrend targeting buy side liquidity? Identify where liquidity is resting at. Look at the highs, look at the lows of where liquidity is most likely at, and then observe price action during the day and what level of liquidity price is drawing towards. This is crucial, because if you can look at this and somewhat have a hypothesis about what level liquidity is most likely to draw towards, that helps with your directional bias as a trader, which is very important. This is just a introduction into market structure, into liquidity. If you guys want me to make more videos about more strategy based and other components you can add to this to have a full fleshed out working strategy, I'll make them inside of the future. So I hope you guys enjoyed, and I'll see you in the next video.